The ultimate buy and hold 10 stock portfolio. Hi, I'm Doug Weiss, and welcome to Wise Investing. I've been an investor and a trader for more than 40 years. All of the research that I've done, all of the evidence I've seen, and looking at my own performance and my own portfolios has led me to believe that buy and hold investing is by far the best way to create long-term wealth. In this video, I'm going to share with you the 10 stocks that I've purchased in my own portfolio as a 10 stock ultimate buy and hold portfolio. First, I'm going to show you what these 10 stocks are. Then I'm going to go into a little bit of depth about why I purchased each of these stocks. Then I'm going to explain why I believe that buy and hold investing is by far the best way you can go. First, here are the 10 stocks. Apple, AMD, Amazon, Google, J&J, JP Morgan, Microsoft, NVIDIA, Palo Alto Networks, and Procter & Gamble. First, we have Amazon. Amazon is a $1.8 trillion company. Mainly, it sells merchandise, but its cloud service is a big part of its business. When you look at revenue, merchandise is about 40% and cloud service is only 16%. But actually, in terms of profit, Amazon Web Service, which is their cloud service, is the king. They're making $22 billion on just cloud service. I believe over the next 10 to 20 years, Amazon is going to be the merchandise company to own in the United States. Apple Computer is a $2.9 trillion company. By far, iPhone is their biggest selling product. They make $200 billion a year selling iPhones. iPads are $28 billion, wearables are $40 billion, and services, which is their fastest growing segment, is an $85 billion business. Apple has a huge potential with AI. No one yet has found a consumer device that delivers AI, but also there's the wearable segment. Right now, Apple's big wearable is the iWatch. I believe over time that iWatch is going to be the #1 health product sold in the United States. AMD is a $278 billion company. Its big product are chips. Right now, it's the second leading company that's producing AI chips. It also does chips for gaming and computers. This stock has been providing the picks and shovels for companies that are trying to get into the AI space. Google, otherwise known as Alphabet. This is a $1.8 trillion company that's main product is search engine advertising. The reason why I'm picking Google as one of my top 10 picks is YouTube is actually one of the biggest, if not the biggest, media company on earth. And no one is valuing Google based on YouTube. YouTube has grown because of AI. Next up is J&J. J&J is a drug company. It's a $374 billion company that makes drugs, implanted devices, and consumer products. In the healthcare space, J&J is a leader, and it's an extremely solid company with steady earnings year after year. JP Morgan is one of the best banking companies to own. It's a $500 billion company. Its main businesses are banking, lending, and commercial banking. Many people consider JP Morgan to be one of the best run banks in the world. Microsoft is a $3 trillion software company. It is the center of AI software and AI interface right now. If you want to invest long-term in the AI boom, Microsoft is a very solid bet. NVIDIA is a $3 trillion company that's basically the ground center of AI. The AI boom has been in large part because of the chips that NVIDIA create. Any company that wants to use AI or use generative AI in their products is going to turn towards NVIDIA to do this. Palo Alto Networks. This is an $11 billion company, and it's by far the smallest company in my list. Its firewall is considered the best for large companies that are doing cloud work. If you're going to look at internet security, and you're a large company, the first place that you're going to turn to is Palo Alto Network. Last is Procter & Gamble. This is a company that has so many famous leading brands. It's in beauty, home care, baby and feminine products, grooming, food. This company is also quite international. Its international revenue is 63% of its total revenue. So it's not just in the United States, it's a leader worldwide. Why is it that most investors only get a 4% rate of return on their investments? Did you hear that correctly? A 4% rate of return. I've looked at several studies that look back over 10 years, 20 years, and even 30 years. If you look at people's brokerage accounts, what they're actually getting as a rate of return on money they hold in a brokerage account, on average, investors are only getting a 4% rate of return. Now that compares to the rate of return of the S&P 500, which, how far back you look, is between a 9 and an 11% rate of return. Now the S&P 500 stays always invested, and it's invested in the 500 largest companies in the United States stock market. That compares to an investor who might be keeping their money in cash, they might be putting it in bonds or CDs, and in and out of stocks. But why is it that the average investor is getting such a low rate of return when you compare that to what the S&P index is? 5 mistakes that almost all investors make, and that's the reason why they only get, on average, a 4% rate of return. Thinking you can time the market. We all believe we can do this. We all think we know when you should be in the market and out of the market. We all think that we know the right time to buy a certain stock, and we put all our money in. Are we usually right? No. A lot of times investors miss the biggest days in a stock. They miss the biggest days in a market. Even if you're investing in indexes, if you're going in and out of the index, most people don't time the market well. Did you know that in any given year, almost the entire return of that year is due to just 3 or 4 trading days? When you look at studies on the stock market, almost the entire gain of 1 year, if the stock market returned 30%, a lot of times that 30% was just due to a few days, to 3 or 4 trading days. The rest of the year, the market just went back and forth. Why? Because the market reacts to news. They react to events, a war, changes in interest rates, changes in the economy. Those big events alter the market. And a lot of times, there are days when the market moves a tremendous amount. If you think you can time the market, then what you're saying is you know the future and you know the days to be in or out of the market. Well, a lot of research has shown that people don't know. That the average investor gets a 4% rate of return because they simply don't know which days to be in or out of the market that they can't time. The second biggest problem is that investors tend to chase rising stocks. When do you want to own a stock? Of course, when you read a news article that it went up 100%. Once a stock has doubled, a lot of people want to buy in. That's why it keeps going further and further up. But is the valuation really there? Is the stock really worth twice as much as it was priced at a month ago? Sometimes yes, but most of the time no. Chasing a stock that's already gone up a lot, that's one of the reasons that people tend to lose money. Because what happens? When you finally buy into the stock, that's when people are realizing that the valuation of that stock has gotten way ahead of itself and it'll pull back with you invested in it. The third biggest thing is overreacting. You see a news article that stock isn't going to do well, or some guru is on television talking badly about a stock that you just invested in. What do? Pull the sell trigger. You sell everything because you don't want to be stuck again in a stock that's going to do badly. But what happens? You look back at the news a week later and that stock has gone up 10% from where you sold. I've done it. Many people that are watching this video have done it. Overreacting to the news is one of the worst things you can do. But if you are an individual investor, it's one of the things that you do most often. Several studies have shown that people selling on the news is actually one of the worst investment mistakes you can make. Why? Because a lot of big companies recover. If you're talking about a company like Apple or Microsoft or Facebook or even Tesla, a lot of times the news is bad about these companies because those are popularly owned stocks. So they're going to be in the news, good and bad. And when they're doing bad, news companies love to run those stories. The next biggest problem is holding the winners too long. Now, what do I mean by this? Why wouldn't you want to hold a winner? Well, the truth is, a lot of companies have their day in the sunlight. A lot of times, Nvidia or Microsoft or Apple have really good runs. Their stocks will rise 20, 30, 40%. But do you want to keep holding after that rise? I know this might sound like I'm contradicting myself, but you want to take some of those gains off the table. If you just made 40% in Nvidia over the last 12 months, doesn't it make sense to take some of that 40% gain off and invest it in a stock that might not be doing as well? That's something that I've learned statistically will improve your returns. Not selling the whole position in a winner, but selling part of the gain and then reinvesting it in other stocks that maybe aren't doing as well that year. That's one way that you can actually maximize your profits and reduce your losses over time. The last mistake, and probably the one that I think most of us make, including me, and it's what prevents us from actually getting better returns, is believing that you can beat the market. Believing that you're smart enough to consistently do well. What gives us that feeling? Success. One of the things that we all have is something called survivor bias. We look at something when we're successful and we think we can keep doing it. I've done that. I've had times when I've made 150% return on one stock, and I think I can do that again and again. The truth is I can't. Most people can't. In fact, even people like Warren Buffett can't. Nobody can do this. It's something that's just unheard of, but we all believe we can do it. And it's that belief that keeps us in stocks too long and allows us to hold things that are losing way too long in hopes of getting back our losses. The answer to all of this is to be a buy and hold investor, is just to stay invested in stocks. That way, you can at least hope to get what the index gets, to get the index return. But I believe you can even do slightly better than that, which over time really will maximize your gains. The average investor would really benefit from having a way to beat the index, to beat all of the active investors, to beat the professional investors. And I think there's only really one answer, and that's a buy and hold portfolio.